Professor Karn back with you, illustrating steps 6A, B, and C, preparation of the financial statements in our accounting cycle from start to finish problem with Walton's Quality Automotive. So we need to first complete the income statement. And remember, the only two things that go on the income statement are revenues and expenses. So we'll go back to our adjusted trial balance here in step 5C, and we'll look and see what we have as far as revenues and expenses are concerned. Okay, so it looks like when we start here, we have one revenue, and then we have a bunch of expenses here. So first thing we will do is we'll list our revenues. So we have revenues here, and the only one that we have is service revenue. And we see that revenue is $16,600. Now, let's make a comment here that's very important for you as a student to understand. Notice that on the financial statements, we have multiple columns here. The first thing you have to realize is that these columns do not mean anything in regards to debits or credits. So what you have to realize is that these are only math computational columns to help us add and subtract. Now remember, you are preparing this not only for you, but for an external user. So what you have to realize is here that you want to make it as easy as possible for someone to come along and pick this up and understand what it means. All right, so because we only have one revenue account, we'll just go ahead and put the $16,600 over here. That's total revenues. And then we can get right into our expenses. Now, our expenses here, let's go ahead and bold that category. Okay, so we just go back, and I'm just going to make this real simple. I'm just going to copy and paste all of these expenses directly into our other sheet here. So we have salaries, rent, utilities, advertising, supplies, insurance, interest, and depreciation expense. So I'm just going to come over here and I'm just going to paste that right into here. Okay, so now the reason I did that is because the reason I put the numbers in this column is I want to total up and get a total expense figure. So if I get a total expense figure, and let's go ahead and indent these a little bit. And there's nothing to do with crediting or anything of that nature. It's just more of a neatness factor here, this indenting. And if you didn't do it, it would not be wrong. It's just more of a personal preference. In your textbook, most of the time they do indent these things. You would not have indented them on the trial, any type of trial balance. So, all right, so let's see, now that that's completed, we can come down here and we can say now we have total expenses. And the total expense number, I'm going to put all the way over into the right column so that we have a very easy calculation, and the total comes out to be $8,480. So now I can see that my total revenue is $16,600. Subtract out total expenses. In this case, we know revenues are greater than expenses, so we are going to have a net income in this problem. So we would take $16,600 minus $8,480, and we get $8,120. I'm going to go ahead and, for this demonstration purposes, go ahead and highlight that in green because that is a net income. Now, we definitely still need to follow our format. We would definitely put a double line underneath of the total, and then we also have to make sure that we have a regular line to signify that we are subtracting there. So there we go. Okay. All right, so that completes the income statement. And notice that this income statement did have the proper heading. We had Walton's Quality Automotive. We were preparing an income statement, and again, it was for the month ended December 31st of 2016. Don't forget the small details. The headings are important. Again, we are not just preparing this for us. We are preparing it for other internal users and external users as well. Okay, so we can now come down here and we can go ahead and have the statement of owner's equity kind of on the same sheet here. And I've already put the heading on this, so we can go ahead here and figure out how we're going to do this. Now, remember back to our lecture period, lecture PowerPoint, we had base, B-A-S-E. So let's go ahead and fill that in. We're going to need the beginning balance of the Walton capital account. Okay, and then we have two sections, one where we add stuff and one where we subtract stuff. And then that yields our ending balance of the Walton capital account. Okay, so now here's what we have to be careful of. You want to make sure that you understand that you have multiple things to look at here. Now let's go back to our initial thought in this problem. Remember, we started this business in the month of December, so obviously the beginning balance of the capital account will be 0. So we would put that in there. And let's change the format of that. I want to change it so that it, we'll change it to this so you can see it's 0. There we go. And then what we have to remember here is on the first day, if we go all the way back to steps 1 and 2 here, remember the first day Walton contributed $55,000 of cash to the business in exchange for capital. That would be an owner investment or owner contribution. So let's go ahead and fill that in there. We would add that in. So we'll say owner investment. And that was $55,000. You have to be careful here. If you did start off the business at the very, very beginning, you definitely would have a 0 balance. But after this month, the capital will always have a balance going forward. Okay, then we'd go to, do we have any owner's withdrawals? And we would go back to our adjusted trial balance here. Notice that we do have withdrawals, $4,000. So we have to subtract that from the owner's equity. So we would put that owner's withdrawals. And that was $4,000. We'll go ahead and put that in parentheses here to signify that as a subtraction. Sometimes you may not do that. That's okay. Just watch the format from my accounting lab on that. Okay, and then we finally have what we have to do with our income statement. Remember back to our PowerPoint lecture on this, and we think about the 4 things that impact owner's equity: withdrawals, investments, revenues, and expenses. We went ahead and took care of the withdrawals and investments. So now we have to deal with the revenues and expenses. And because we have net income of $8,120, we have to add that in. So we'll add that down here. $8,120. Okay, now what we can do here is we can actually, we'll subtotal this out. Let's total this up here. We'll do this. Okay, so that got that. So we'll put subtotal here. So we would take the 0, obviously we would add the 55,000 and the 8120, and we get a subtotal of 63,120. And then we just simply have to subtract out the withdrawals. So we'll go ahead and put another line underneath here to signify we're going to subtract that. So we would know that really 63,120 minus the 4,000. I'm adding it here because it's already a negative number, so that's how Excel would have to calculate it to subtract it. So 59,120 would be our current amount of our ending balance of the owner's capital account. Let's do this. Let's draw a double line there. Now I want to highlight the net income in green because that I want you to see how that was brought forward and to learn that how the financial statements are interrelated. So you can see how we had to bring this highlighted green bar cell of net income down here and include it in the statement of owner's equity. Obviously we needed to do the income statement first to help us prepare the statement of owner's equity. Now I will then highlight this in blue and show you how we need to bring that forward into the balance sheet, which we'll prepare next. Okay, moving right along to that, we'll go right here to that here. Okay, so now we have the balance sheet. Again, we have our heading, our proper heading, Walton's Quality Automotive. We have a balance sheet we're preparing, and remember the balance sheet is for a specific date. Now what we have to keep in mind here is that they want us to prepare a classified balance sheet, and that's going to break it into different sections. So we'll have current assets, we'll have plant assets, we'll have current liabilities and long-term liabilities, and then our capital. So let's see how this works. Let's start off with assets overall, and then we'll go with our current one. So we have current assets. Remember, current assets are anything that we will probably use up or go through within the 1 year or one operating cycle. So obviously the first ones would include cash, so we're going to put that. Let's go ahead and put that right here. We'll put cash for $44,800, and again I'm just getting these off of our adjusted trial balance. That's a thing to remember I didn't really mention earlier. Make sure you're definitely, when you're preparing the financial statements, you're definitely using the adjusted trial balance figures. Okay, then we go to our our accounts receivable, and that was for $2,600. Then we have prepaid insurance, and that was for $1,000. And then we have, the prepaid insurance was for $1,200, and our office supplies that we have are for $1,000. Okay, so that would give us then the total current assets of, if we added all these up, we would get $44,800 plus $2,600 plus $1,200 plus $1,000. We get $49,600. And let's go ahead and put a line there to signify that we made a total there. Okay, then we would go to our plant assets. I think I'm going to go ahead and just kind of put an indentation on these here to kind of signify that each category. I think that makes it a little clearer because it looks like it's all running together so much. Let's see what we have here. Okay. Then we can do our plant assets. Remember, plant assets include anything that is depreciable, things like equipment, machinery, building, car, truck, van, those types of things. And remember that we will not depreciate land because land has an unlimited useful life. It's here for perpetuity, so the land's useful life would never run out. So, but it will still be considered a plant asset. Okay, so now let's go ahead and put that here, plant asset. Okay, the first one we have here was the equipment. Now remember, the key thing I said in the PowerPoint lecture was the fact that we have to calculate the book value of the equipment. And the way we do that is we have to take the cost, in this case the $9,000, we'll put that here, and we will subtract out the accumulated depreciation. So we'll put less accumulated depreciation equipment, and that would be for $150. Now what we have to do here then is we have to total this up, and show that calculation in the actual balance sheet. So we have 900, it should be 9,000 minus $150. So we know that we are at 8850. And then the other plant asset that we have here is land, and that's 16,000. Okay, so our total plant assets can now be added up. Total plant assets come out to be $24,850. And we have that to total up there. We'll put a line there. Now, we can now add up our total plant assets. Indent that there. Total plant assets plus our total current assets will equal our total asset figure. So we will take the 49,600 plus the 24,850, and we see that we get $74,450. Okay, and I will highlight that in orange because we definitely have to have the total assets then equaling total liabilities plus owner's equity. And we will put a double line underneath the 74,450 to show that that is our answer. Okay, then we can skip a line and we can go down here to liabilities. And in a classified balance sheet, you want to separate the current and the long term. So let's do current first. Again, current will be paid off or come due within one, actually will be due within 1 year. Doesn't mean it may be paid off. Hopefully, obviously will be. And then anything longer than 1 year out would be a long-term liability. So we have current liabilities consisting of accounts payable, and we have that coming out to be 1,700. Let's put this here. Then we have, give me 1880 on that. And then we have interest payable. For $50. And then we have unearned revenue in the amount of $1,400. So we have to then add these three things up. Those will be considered our total current liabilities. And that comes out to be $3,330. Let's total this up here. Okay, then we get to our long term. And remember, long-term liabilities are anything that's due within longer than 1 year from now. So it looks like we just have the one, and that would be notes payable. Pay that back in 5 years. Now, let's say you had a mortgage payable. Obviously, that would be a long-term liability. However, in that case, you would have a current portion of the mortgage payable that was due within 1 year. That would be in the current section, and the other part of the mortgage payable would be in the long-term section. Okay, the notes payable was $12,000. So our total liabilities comes out to be $15,330, and that is the total of the $3,330 of current liabilities plus the $12,000 of long-term. And then we get to our owner's equity section. And again, this is a common mistake that you don't want to make. We have to take the Walton capital balance from the statement of owner's equity that we prepared in step 6B, which is the 59,120. We need to bring that over here. So we'll bring the 59,120 there. I'll highlight that in blue to show that that's being brought over from the statement of owner's equity. And now we can go ahead and we can total up total liabilities plus owner's equity so we would take the 15,330 plus the 59,120 and notice that we get 74,450, which is the same amount as our total assets, so we are in balance for our balance sheet. A couple things to clean up here. Let's put this in yellow so we can see that that matches total assets. Let's put a line underneath of this here, show that we added that, the 15,330 plus the 59,120, and then we need to put a double line underneath of this. Okay, so that concludes the illustration of preparing the income statement, the statement of owner's equity, and balance sheet. The next video in lecture, we will talk about step 7 of the accounting cycle, which is the closing process.